Welcome to week 11 of tax season, everybody. We only have about 4 weeks left. My clients only have 2 weeks left to get me their stuff so that I can guarantee on-time filing by April 15th. So be working to get this done. I know that I'm ready to be done with 2020. I'm pretty sure you all are ready to be done with 2020. So let's get this knocked out so that we can all move on. It'll be a good thing. So this week we're going to be talking about depreciation. This is an area that is convoluted and confusing to most people, and rightfully so. So today we're going to talk about exactly what depreciation is, what should be depreciated, and over how much time those items should be depreciated over. So starting with what depreciation is. Okay, so you purchase an asset that you're going to have more than a year. Maybe you consider it a supply, but it's something that you're going to have over a year, maybe multiple years, and is going to help you in the production of income. So what we are doing when we depreciate an item is we are taking the expense of that income and we're spreading it out over a few years so that each year that benefits from the income producing powers of that particular asset shares in the expense of that asset. So if you buy a $1,000 item and we're depreciating it over 5 years, each year that you have that item, sometimes you have it even longer than 5 years, is going to get part of that tax deduction. And that's really why we do it, because you're going to be earning income from that asset over multiple years. And it's just a way of spreading the love, okay? Now, what should be depreciated? Well, here's what the IRS says. The IRS basically says that if you purchase any item or asset that is going to be used for more than a year in the production of income, then you need to capitalize and depreciate that as an asset. There are no minimum dollar thresholds, which is why sometimes I see a tax return come in where in a previous year, a tax preparer has put on a $10 flower basket to be depreciated over 7 years. There's just no way of really gauging what you should and shouldn't be in terms of a dollar threshold. So it's really up to you as the small business owner. And theoretically, you're talking to your CPA about that. Now, larger companies will very often use much higher thresholds. So for example, a very large company will say, hey, if we purchase an asset, it's $5,000 or more that we depreciate. Anything less than that, we expense. As small business owners, you don't really get the luxury of choosing those very high thresholds. So you need to choose something that's a lot more reasonable. And if you're relying on your CPAs, note that we all have varying degrees in terms of our thresholds, which is why you find a $10 flower pot on a depreciation table. For me, my threshold is $250. So what that means is if you purchase something that's $250 or more, and it's going to last you more than a year in the production of your income, then we're going to capitalize and depreciate that over time. So you can see it's very vague, but make sure you are working with your CPA or tax provider, tax preparer to help you get that all hammered out, okay? Now, how long are we depreciating these items over? Well, there's a couple of things you need to know first. One is that there's depreciation for tax purposes, and then there's depreciation for book purposes, which follows something called GAAP, generally accepted accounting principles. So what you see in your books may be different than what is happening on your tax return. So make sure you keep that in mind when you're moving forward, okay? We generally use, in terms of depreciation for book purposes, the same number of years for an asset, but we'll also use straight line, and we'll add something called salvage value into it, and we'll do some different things for book purposes than we do for tax purposes. So that's, first of all, you need to understand that. Now, in terms of how long we depreciate certain items, it really depends on what is being depreciated. So, for example, computers and vehicles are depreciated over 5 years. Then you have furniture and equipment, which is depreciated over 7 years. However, if you're an individual who invests in property, if you have a residential property, that is depreciated over 27.5 years, while commercial property is depreciated over 39 years. And then there are the things that you add to those properties. For example, you're renting a residential property and you need to buy a new stove. Is the new stove depreciated over 7 years, or is it depreciated over 27 and a half years? And in this case, the stove would be depreciated over 7 years. But what if you buy a new water heater or an HVAC or an air conditioner? Those things tend to be depreciated over 27 and a half years per IRS regulation. So there's a lot involved in all of this, which is why you really need to be talking with your CPAs as small business owners to make sure that things are fitting in the correct places. Now, there are also these other things called bonus depreciation and Section 179. Now, Section 179 is one of my favorite tools for my clients who are making a lot of money, because towards the end of the year, I may call them and ask them to buy assets specifically so I can use Section 179. And what Section 179 allows me to do is depreciate the cost of an asset all in 1 year, up to a certain point. Most of my clients aren't actually going over those thresholds that are dictated by internal revenue regulation. So that is a tool that we use. But as you can see, you, again, really need to be working with your tax preparers to understand what's going on. So make sure you're reaching out, getting things in the right places, and hopefully you're using depreciation to your tax advantage. Depreciation is something that can be used to your tax advantage as part of your tax strategy. So it's something to be bringing up. Now, many of you, almost all of you, have something that can be depreciated, okay? So your computers. I'm sure most of you have computers that you're using for business. Now, you might be using it a little bit for personal. Many of you have vehicles that you're using for business. So the thing that you need to understand about those items is that as long as you are using them for 50% or more for business, or more than 50% for business, then you get to depreciate part of that item. So you may use your computer 80% for person or for business and 20% for personal. And if that's the case, we'll want to depreciate 80% of the cost of that computer. Same with your vehicles, okay? So there are a lot of different caveats and fun little eddies and streams and outcroppings when it comes to depreciation that can be an important part of your tax strategy. So be talking to your CPA. Have I said that enough in this video yet? Okay, so next week we're going to be talking about what an employee is versus what a subcontractor is. And I know that seems like a strange thing to be talking about during tax season, but it is a very important thing that can get small businesses into trouble. And it also affects how we expense things and additional things that need to be done. So that's what we're doing next week. Of course, if you have any questions about depreciation or anything else for that matter, my contact information is always at the end of these videos. Feel free to reach out, and I'm more than happy to have a chat with you. Take care, everybody. We'll see you next week, week 12. Take care.